Welcome to Unit 2. The objectives of Unit 2 are as follows. When we complete Unit 2, students will be able to record transactions that affect assets, liabilities, and owner's equity on a transaction analysis sheet. They will be able to prove the mathematical accuracy of a transaction analysis sheet, and based on the transaction analysis sheet, they'll be able to prepare a balance sheet from all the information that they have written on the sheet. First of all, we need to understand what is a transaction. The definition of a transaction is a thing A transaction is an exchange of things of value. Notice in this chart that something of value is given on the left, and on the right, in exchange for that, something of value is received. This is a transaction. For instance, I may have $500 that I wish to purchase equipment with, so I give $500 to someone who is selling the equipment. The person receives my $500 and I receive the equipment, which I feel is worth $500. This is a transaction. Now let's take a look at what is a transaction analysis sheet. It's simply an accounting tool that helps understand how transactions work and how they affect the balance sheet. Balance sheet items are placed in equation form to understand their effects, and we'll take a look at that on the next slide. Before we do that, we need to understand what is the accounting period. The accounting period is a period of time covered by financial statements. Depending on the type of business, the accounting period could be 1 week, 1 month, 1 quarter, 1 year, or any combination thereof. In order to understand how the transaction analysis sheet works, we need to turn to page 16 of the textbook. Here we will look at the example of Goldman's Gym. Notice that the balance sheet for June 30th for Goldman's Gym is listed on the page. Here we see a list of all the asset accounts, the liability accounts, and the owner's equity account. We take all of these accounts and we write them on the transaction analysis sheet. Please take a blank sheet of paper, turn it sideways, and transfer the information from the June 30th balance sheet to this sheet of paper, and it'll be called the transaction analysis sheet. Notice that when we complete the transaction, we have the totals of the assets at the top, we have the totals of the liabilities at the top, and we have the totals of the owner's equity. Notice we have an equal sign here and a plus sign here. Assets are on the left side. The equal sign is in the middle between the liabilities and owner's equity and the assets. And joining the liabilities and the owner's equity is the plus sign. We have taken all the accounts from the balance sheet and we have listed them across the top. We can abbreviate if we wish, and we list all of their amounts. Notice we have an equal sign here between the left side and the right side, and between each individual account we have a plus sign. So all the items have been transferred from the balance sheet to the transaction analysis sheet. Now let's take a look at the first transaction. Transaction number 1 is an asset purchase for cash. The date is July 1st. On July 1st, Goldman's Gym purchased new training equipment for $500 cash. We need to ask ourselves 4 questions when we analyze a transaction. First of all, which items change in value as a result of the transaction? At least 2 must change to keep the equation in balance. 2, how much do the items change? 3, do the items increase or decrease in value? 4, after the change is recorded, is the equation still in balance? So let's continue with this first transaction. Notice that we add the fact that $500 cash was spent in this transaction. So that means cash has gone down by $500. So what did we spend the $500 on? We purchased, or Goldman's Gym purchased, $500 worth of training equipment. Now we take these changes and we apply them to the original amounts of the individual accounts. So 5,000 subtract 500 will give us 4,500. And 94,500 plus 500 will give us 95,000. So all the other accounts remain the same, but the two accounts affected have been changed. Then we talk about transaction number 2. On July the 5th, office supplies were bought for $55 on credit. This is very important to know, that when you buy something on credit, you are not using cash. And they were purchased from Central Supply Company. These two transactions are listed in the appropriate accounts. Which two accounts are affected? Right here we have office supplies going up by $55, and because they didn't pay with cash, the accounts payable goes up by $55. These are the two accounts that are affected. So we have to make note of the fact that they were increased by $55. Then we have to total all the different accounts. The ones that were changed do get changed, and the others remain the same. So office supplies started at 500, now it's at 555. Accounts payable started at 4,000, it's now at 4,055. On July the 10th, in transaction 3, Goldman's received $3,000 cash from customers who owed them money in the past. How do we record this? Well, when they pay us with cash. So our cash goes up by $3,000, Goldman's Gym cash. And where did the money come from? The accounts receivable that used to be owed to us is no longer owed to us because our customers have paid us. So what they owe us has gone down $3,000. So cash goes up $3,000, accounts receivable goes down $3,000. And how does this affect the totals? 4,500 plus 3,000 gives us 7,500. 6,000 minus 3,000 gives us 3,000. Your assignment today is to turn to page 18 and complete the additional 4 transactions on the transaction analysis sheet that you have created.